A warm welcome to all the participants in today's webinar. The IT and BPO industry has been through 8 quarters of slow growth, and during this time, the resiliency of the industry has been tested. Buyers' decision-making has gone through a significant change, and providers have had to pull various levers to tide through these tough times. In the webinar today, we will cover the key commercial trends witnessed in outsourcing deals in APAC in H1 2024, and what the implications of this is when it comes to the second half of the current year. So for today's agenda, we're going to cover 3 broad points. The first one is a recap of some of the recent market developments. Next, we'll move on to what the key observations are with regard to buyer expectations and what are the open questions to be investigated still. And thirdly, how can enterprises maximize the value from their outsourcing as well as the cloud and SaaS deals? With this context, let's move on to the next page and recap the key observations from the first half of 2024. Now, from the perspective of buyers, the current year has been a pretty tough year in general. At a high level, there are 4 important things to keep in mind with regard to the recent market trends. Firstly, when it comes to software products, there is a very high degree of change in the product roadmaps that product vendors have. They've already introduced some changes in core products, or they are in the process of introducing those changes, forcing buyers to make difficult decisions around the product choice itself. For instance, SAP ECC support end date is very near, and buyers are forced to either move to SAP S/4HANA or other ERPs. On similar lines, with Viva moving away from Salesforce and having its own CRM platform going ahead, life sciences clients have now to make a very important decision whether to stick with Viva or not. There are also vendors who have got onto the generative AI bandwagon and are offering add-ons in addition to the ones that buyers have already purchased. And these add-ons come with hefty additional licensing fees in most cases. All of this has happened at a time when the global economy is still close to recession. The demand for products or services offered by the clients are still seeing a slowdown. As a result, to maintain their own profitability, buyers are forced to stay within tightened budgets for technology services, as well as BPO services. Finally, it's been about 1.5 years since the advent of generative AI, but there is hardly any medium or large size buyer, that has not got into pilot projects with regard to generative AI. But there are just a handful of such clients which have actually deployed generative AI at scale in production. As a result, there's a lot of fatigue when it comes to the Gen AI pilot projects. Let's have a detailed look at some of the other factors shaping these trends. Abhishek, what are some of the APAC specific factors which come to your mind?
Sure, thanks, thanks, Rahul. I think when it comes to APAC, right, there's just the variation among regions within APAC tends to be so much that it's hard to kind of just qualify everything as one trend or the other. So let me just start with perhaps Japan, where we're looking at an economic slowdown and an acute shortage of technology professionals, right? On the other hand, there are rising large deal opportunities, right? So that becomes a bit of an oxymoron at times, that there's demand, but then there's also the economic slowdown. So that has its own kind of challenges to serve. With China, yes, again, there is a bit of an economic slowdown. There's also a lot of data privacy regulations, and perhaps that's why local players tend to dominate. And then there's also an organization's motion to de-risk from China. If you look at kind of the India, South Korea, right? If you were to kind of club them, there's strong demand within India, of course, being the delivery powerhouse, right? But then also from a market perspective, India as a market, There's strong government push for infrastructure digitalization across different cities, which will spur demand. Same for South Korea, right? It's huge demand for manufacturing and technology sectors. But then over there, there's a less developed supply ecosystem for services, right? And then, of course, there's in the ANZ region, there's high delivery costs, and then commit along with a commitment for better kind of overall investments in digitalization, right? ASEAN, of course, being a fragmented market with varying maturity levels. So I think as we look at APAC, that's why it's important to look at it in the context of specific sub regions as compared to perhaps other geographies like, let's say, Europe or North America, where we can start to paint a few things in a common brush. So that's where APAC's challenges and demand trends, we'll see a lot of variation depending on the country. Having said, this was more about services. There's also the whole concept of software license costs. So if we were to move to the next page, right, perhaps we can cover some of that, which actually is much more consistent across different geographies just by the nature of the product, right? So we know for a fact that organizations across industries have been facing price pressures from their software providers, right? Some of which you can see on the screen, right? Almost all the major ones have significantly increased their prices in the last 12 to 18 months. And those who have not are catching up with their peers, and almost on a monthly basis we hear something or the other coming through about an expected price increase, right? For instance, IBM increased their prices for infrastructure as a service offering by almost a whopping 25%. Salesforce 9% on average. Adobe, HubSpot, all of these have increased their prices significantly. And Microsoft, not to be left behind, announced an increase in Dynamics 365 prices by 17%, which is going to be effective from October this year, right? Now, while increasing business profitability, yes, is one of the reasons behind the hike, providers, the software vendors also attributed to enhanced features and functionalities, and a bit of the innovation in their product, right? So again, there are, just to summarize, there are clear signs of, cloudflation, as we call it. They have been increasing significantly and will likely to continue to increase through the next year. This is also a sign of the fact that, with these many of these vendors, with the cloud adoption becoming much more commonplace, the switching costs are very high, right? So that's why, it also gives the market some permission to increase prices, in addition to, those added features, and which is all part of their strategy. On the next page, let's try and also cover another major vendor's price increases, which are calling strategy, right? And this is basically, Broadcom, the way it has significantly changed VMware product bundling. And it's not just about pricing and metrics, it's also about how things are bundled and how they're being made available, to the market. One, they've simplified the product offerings into two bundles. Fair enough, right? There's a shift from perpetual licenses to subscription access, right? Which, on one hand, it allows customers to benefit from recurring payments instead of a large one-time purchase. But then, depending on which way you're looking at it, sometimes, recurring benefits may be better. Sometimes, one time may be better. Sorry. There's also then the move from socket to core-based licensing and a new requirement of buying at least a certain number of cores, which has implications on overall budgeting of people. Vaibhav, what are some of the discounts applicable, right? We've seen, and for this case, do they really help?
So Abhishek, discounts can range from 8 to 35%, depending on the bundle and the subscription term. So this restructuring might reduce costs for customers who are deeply integrated into the VMware's ecosystem, but dramatically raise expenses for users buying single products. So moving the dial back to services, let's discuss on the next slide how service provider criteria has kind of shifted. So it's really interesting to see how quickly the market dynamics end up shaping the buying criteria globally. While evaluating recent deals, we have noticed an increased focus on getting the most value from outsourcing contracts. So several critical factors are being considered by buyers. Firstly, the focus is on pricing and contracting. So not only meeting cost expectations, but also achieving buyers' long-term financial objectives is important. Second, the solution must align with the organization's quality goals and also match the client's delivery model. Third, I think it's essential to choose a provider with a proven track record to ensure they can deliver the required services reliably. Fourth, strategic alignment is crucial. The partnership must drive mutual success. Finally, the transition process. So buyers need to feel confident that risks will be minimized and overall handover will be smooth. So net-net, while solid metrics matter, these broader strategic factors are key to making a successful outsourcing decision. I think with that context on evolving buying criteria, Arpit, do you want to share your perspective on the market movement?
Sure, Vaibhav, thank you. And if we move to the next page, the overall market sentiment, as you see, has been echoing slowdown from last few quarters, right? And it is evident both in industry charts as well as geography growth charts. Uh, Even today, Vaibhav, as you mentioned, pricing and contracting has been the major driver for selecting new service providers for new opportunities in the current market. But all is not doom and gloom, right? We can see that there are certain sectors in industry like TMT and BFSI which has shown an upward trend in last 1 quarter or so. And in terms of geography, Asia Pacific especially has been bucking the trend against all the other geographies with respect to last 3 quarters. Specifically, last quarter it has shown good growth. Even North America has shown the growth from the last 1 quarter, and we are definitely seeing the green shoots of recovery in certain sectors and certain geographies. But if we consider this in conjunction with the pricing trends, and if we go to the next page, the pricing trends, no surprises there, have been flattish, and we have seen degrowth and reduction in some of the traditional IT skills and the traditional BPO skills, and specifically in offshore centers, right? There have been slight uptick in the prices for domain-based BPO skills and the specialized IT and cloud skills, but that's not because of the market demands, but rather that's because of the shortage for these type of services. So overall, we can see that the RU-based pricing and the FTE-based pricing has been flattish, even degrowing for some of the offshore centers. And to talk about output-based pricing and what we have seen the decline, Rahul, if you can just help us understand what have been the reasons for this decline of output-based pricing in the last 12 months.
Yes. Moving on to the next slide then. So Arpit, there are three key reasons, that one can talk about. The first, rate cards in the APAC market are under continuous scrutiny as providers expand their service delivery presence in existing as well as newer countries from where they're delivering services. There are also country specific factors. For example, in Japan, the forex movement has supported more competitive rate cards, and this is also accompanied by increased presence of local and regional providers, which are providing stiff competition to some of the established tier one global players. Second, the prevalence and quantum of volume discounts has increased, and this is to a large degree due to the sustained increase in offshoring and nearshoring in the APAC locations. So with the increased volume of work that is being delivered from these countries, there is, a greater focus from buyers to get discounts especially for large size deals. But even in some of the mid-sized deals, we have seen discounts of somewhere between 4 to 7% being offered. And it's not just about rate cards, there's the increased scrutiny is also visible in other dimensions. For example, favorable payment terms. Clients in APAC are becoming more aggressive in demanding, longer payment periods, discounts in case the payments are being made in a shorter duration of time. And these demands for favorable terms are not essentially getting pushed, let's say, to annual or contractual milestones. Even when there are some monthly or quarterly governance meetings, we have seen a lot of buyers, pushing the clients, pushing the providers to get these kind of favorable terms and conditions in the overall contract. If you move on to the next slide. Now, the key message is essentially that providers are facing increasing scrutiny to cut prices and to provide more value for their clients. And on that note, even transition services have become a key focus area. As providers demonstrate their ability to deliver not just cost savings, but also greater efficiency and value. And while transition fee amortization in general has been a practice that has been there for a very long time, we are seeing an increase in the number of instances, of either a complete waiver or partial waiver of transition fee, especially in competitive deal scenarios. Abhishek, a question to you. Should we do our quick poll now with our audiences? I'm really interested to understand how our audiences in APAC perceive the impact of generative AI.
Absolutely, Rahul. I think now is the right time to do a quick poll. Agnes, if you could just launch it. The options basically, are 5, as you can see, right? And the question would be, what percentage of Gen AI-led productivity gains are your providers proposing in application development type of projects? Okay, where is this going? Seems to be moving around nicely. We'll give maybe 10 to 15 more seconds. Okay. I think we can now end the poll, right? Yeah. And you can see the results here. Seems to be a mixed bag, more in terms of, the 10 to 15% and 15 to 30%, right? As it's coming through. Rahul, definitely, any high level guidance from you on which functions where we see maximum leverage of Gen AI when it comes to, let's say, IT infra services, for example. We have the one for IT applications, but any view on that?
Yeah. Yeah, interesting point, Abhishek. So yeah, in IT infrastructure services, we are seeing digital workplace and service desk support as being the front runners when it comes to Gen AI use case adoption.
Yeah, sounds good. And Vaibhav, do these results kind of, so are these surprising to you or more in line with what you were expecting?
So they seem to be more in line. These are not surprising results. Yeah.
Yeah. And I think that one of the things which it also says is that, there's a lot of brouhaha sometimes about, Gen AI changing the world and basically taking away any shred of human effort required. That really is not the case, right? It's a great tool when used wisely, but the whole point that it's largely between, the maximum percentage of, respondents think it's between 10 to 15%. I think it aligns with what we've been seeing. Okay, so that's good. Okay, so I think now is the time to move to the next page. In fact, that marks out the next section. We've covered the context on recent market developments. Let's speak now a little bit about what buyers are expecting in today's market. As we move to the next page, right? What better place to start than Gen AI? Right? Okay, now I think if you were to choose what topic has led to the maximum amount of conversation in the past, 12 to 18 months, it has to be Gen AI, right? And then it's no wonder that buyers are turning impatient now, right? That, what really, is coming through. Now, different stakeholders need different levels of information clarity around Gen AI. For example, executive stakeholders need to understand what spend reduction it will drive, right? They're maybe not that bothered about other things. They want spend, the ROI, right, by investing in it. Now, program leaders or line managers need to know what underlying productivity improvement components it will drive, right? What will be the reduction in efforts? What work or tickets will it eliminate? Is there some other implication on, let's say, underlying user experience, right? So it's essential for buyers to ask for this clarity and for service providers to articulate that in order to drive business case, around generative AI utilization, right? So again, to summarize, clients need help from providers, around kind of, some of these services, just to make sure that executives don't lose patience by just kind of, seeing the similar verbiage or similar material being floated around for months, right? Arpit, it's also expected that introduction of Gen AI could drive pricing model changes in IT and BPO services, right? But that will still be seen. But are there some key trends that we can share with our audience on broad movement of pricing models, right?
Yes, sure, Abhishek, thanks. And if we move to the next page, what we have seen and it is interesting to see, Abhishek, that the impatience from the buyers is not only in terms of Gen AI productivity recognition, but in terms of utilizing the newer and innovative commercial models or pricing constructs and the deals which are coming in the market. So, what we have seen in the traditional IT application services, right? The fixed fee and the TNM services constituted over 50 plus percentage, right, in the past, but it has grown down significantly by 5 to 6 percentage point, and that has gone to the outcome based or on output based pricing. The main reason for that is basically buyers want to make service providers accountable and to have that increased transparency in terms of pricing, right? Which was a little difficult in the previous pricing models of TNM and fixed fee models. So that we have seen that currently a lot of the outcome based pricing and the output based pricing has been evolving in terms of usage of Gen AI models as well. In cloud-based services, what we have seen is that the percentage of cloud spend managed model has gained a lot of traction, which we can see from 8% to 15%, right? So obviously, the innovative commercial models are here, and we have been seeing that in all our deals, which we are seeing currently. But Vaibhav, apart from this newer and innovative commercial models, what are the other factors which you see which is leading service providers to newer deal wins?
Yeah, Pith. So there are definitely some interesting market shifts happening towards a evolved commercial model. So if we go to the next slide. So when it comes to even seemingly simple aspects like location selection, we're seeing a noticeable shift towards leveraging tier two cities, such as Jaipur, Coimbatore, and Kochi. So historically, teams have been deployed in a more hybrid manner, with most of the workforce based in tier one cities, and having some operational tasks shifted to tier two cities. But now we are observing a change. So in contemporary deals, it's becoming more common to see entire delivery teams based in tier two cities. For example, in a recent proposal for a European financial services firm, one of the Indian heritage providers proposed using a tier two location, resulting in a very competitive pricing and hence ensuring strong position in the selection process. So we generally see tier two cities being leveraged more in cost conscious and mid-sized RFPs rather than in very large scale projects, because scalability in such tier two or tier three cities still remain a challenge. So Rahul, you've been leading the vendor consolidation exercises we advised on recently. What are your key observations?
Yes, Vaibhav. So, and if you move on to the next slide, a lot of interesting observations on that. Uh, in 2022, we saw a lot of vendor consolidation deals within particular functions. For example, consolidation of vendors within the IT applications portfolio. In 2023, we saw quite a few total IT deals with the price being IT applications as well as IT infrastructure services for the entire portfolio of the end client. While both those types of deals are visible even now, there are also deals that have an integrated BPO plus full stack IT as part of the scope. As an example, we recently worked with a large energy client based in Australia that had already outsourced its entire IT to one leading service provider and certain processes within finance, accounting, and HR to another leading provider. It was now looking to consolidate across these two providers. And the key motivations to do this were essentially to derive synergies in the solution across IT and BPO services, uh, derive synergies on the commercials themselves, and improved performance and user experience overall. So this template has actually gained strength over years. And as the chart shows, the prevalence of such integrated BPO ITS deals is now about 3 times what it was about 3 years back. On the next slide, let's have a look at another example. Now, this is a case study, where the client was a manufacturing enterprise, and it had, a problem, with its current vendor, which was primarily the untimely provisioning of network and portal access and equipment. Uh, and devices as well, whenever new employees were getting onboarded. So, as a result, the employee onboarding, HR help desk, and HR outsourcing functions were having very low satisfaction levels, poor user experience, etc. The client in this case decided to synergize, across the IT and the HR processes, and ended up rolling out an integrated deal to a new service provider. The benefits that it realized in this case were, reduced number of L2 escalations because of delays in equipment and device provisioning, rationalization in the overall employee onboarding cost, HR and IT help desk costs by about 10%, and increase in the onboarding satisfaction score, by about 12%. A pretty good example of the benefits that can be achieved by consolidation of functions across different categories. Moving on, another trend that is visible this year is benchmarking of the overall relationship or contract between clients and service providers. At a fundamental level, contract benchmarking goes beyond plain price benchmarking. Buyers go for a complete assessment of the contract that includes, not just the pricing, but also, the solution and sizing parameters, delivery metrics, terms and conditions, as well as performance benchmarks. And the idea behind a comprehensive contract benchmarking is to align the contract to the, best available market standards. At times, these exercises are done with the sole purpose of realigning the existing contract to the market, because a fresh RFP process followed by a new contract rollout requires significant time and costs, on part of the buyer procurement organization. The savings actually can come in many forms. We recently advised a pharma client around their existing shoring strategy and the COLA contracting mechanism, terms and conditions around IP, solicitation, liability clauses. All of these ended up not just generating cost savings for the end client, which was primarily driven by restructuring their shoring levels, but also by giving them a balanced contract overall. Arpit, again, a question to you. We have spoken about buyer expectations evolving in the current market. What's your point of view around some of the open questions that are still there?
Yeah, Rahul. So if we go to the next page, I think while we discussed few of the contract questions, Rahul, there are still few key questions on which clarity is expected. The most important one being the market complexities which is currently prevailing, will it ease the pricing pressure or will it intensify the pricing pressure? Second most pertinent question is on the Gen AI. What is the measurable impact of the productivity which Gen AI could produce for IT services, for BPO services, and for cloud services, right? And then there is a question on vendor OEM price hike, which we discussed earlier. So how that pricing models impact deal economics for service providers and enterprises. So these are the few areas, apart from other areas, where we are focusing our analysis on as an average group, as an entity. And what we will ask our participants and the attendees is, if you want to uncover any of these areas, one or more of these areas, feel free to reach out to us for any analysis or any insights, and we can help you for sure. So these are the key questions, and I think this ends the second segment of our webinar. And if we move to the next page. Yeah, so this is the last and the third segment of our webinar. And the point which we would want to discuss in our third segment is how enterprises can maximize value from their outsourcing and cloud SaaS deals. And Wabho, as you have seen a lot of cloud deals, what are the optimization levers you are seeing in the managed cloud services or cloud outsourcing deals? Because we have discussed about cloudflation in previous slides as well.
Sure. Thanks, Arpit. So let's go over the key strategies for optimizing cloud spend on hyperscaler platforms. So I think first, right sizing your resources and releasing any unused capacity is important. So I think it's important to avoid wasting money on underutilized assets. Buyers should first try and standardize instances and switch to cheaper options whenever possible. Next, switching to cloud native design. So implementing horizontal auto scaling allows resources to automatically adjust based on demand, basically ensuring efficient use. Then using spot instances. So for non-priority tasks that actually don't need high availability, like batch jobs or background processing, buyers should prefer using spot instances as these instances are heavily discounted. Also, I think taking advantage of savings plan and reserved instances by committing to a specific spend over a set period, you can reduce costs by 30 to 70% for instances that run continuously. Also, overall, keep an eye on cost anomalies. So regularly check for sudden spikes in costs so you can address them quickly and keep the budget under control. Finally, creating budgets for each department. So basically assigning cloud budgets by department and holding them accountable ensures each team is optimizing their spend. Also having regular budget reviews kind of help in preventing the overspending. So now let's look at how companies can use some of the strategies we discussed to negotiate with Microsoft on the upcoming price increase. If we go to the next slide. So as we know, Dynamics 365 will go through a price increase this year. And as you can see on this slide, prices for different products are set to go up by as much as 17% in October this year. So I believe, firstly, some organizations have a price protection clause in their contracts, which protects them from midterm price hikes. So if you have this in your Microsoft contract, you can use it to minimize the impact of Dynamics 365 price increase. Next, I think companies should assess whether they actually need the additional features or not being offered at the higher prices. Because if these features aren't essential, buyers should negotiate to stick with their current feature set and avoid the price hike. Lastly, instead of focusing only on Dynamics 365, companies should leverage their overall spend with Microsoft to secure better discounts across all their products. So I think talking about maximizing value, it's important for organizations to not just negotiate well, but also protect against value leakage in their outsourcing contracts. So Rahul, what should companies keep in mind to prevent value leakage in these contracts?
Yes, Vaibhav. Now, interestingly, in spite of the increased focus from buyers on preserving value and savings, we see continued leakage in outsourcing contracts, for reasons beyond just out of line rate cards. And there are various sources of this kind of value leakage. The first one is essentially what we call solution sizing inefficiencies. This includes things like having uh, staffing pyramids which are not in line with the market standards. For example, it's pretty common to see a bottom heavy staffing pyramid when it comes to various types of BPO services, IT infrastructure management services, IT application maintenance services. But, in spite of that, in a lot of situations, we see that the actual pyramid deployed by the provider may actually be a middle heavy pyramid, in some cases, even a top heavy pyramid, which leads to a lot of inefficiencies. The shoring mix itself is a very big contributor of value leakage. For a lot of services, it's a well-established norm to have pretty high offshoring levels. The moment the actual solution wavers from that and has more of onshore presence, the economics can actually change quite significantly, quite adversely from a client's perspective. There's also the question of location strategy. What are those exact locations from where the services are being delivered? As we discussed a bit earlier, there is increased prevalence of tier two, tier three locations being leveraged in a lot of deals. But sometimes we still see focus being to deliver services just from the tier one locations. So that's the first source of value leakage. Second one is the suboptimal pricing itself. So the rate cards could be misaligned with the market benchmarks. That is a very strong, or that's a very significant contributor to value leakage. But there could be other fee components as well, which could be out of line and which could also impact the total value being derived from a deal or the total economics of a deal. These could be factors like, what are the charges associated with governance and PMO, what kind of fee is being charged for transition, transformation, uh, what kind of a COLA clause is there, and that can be a pretty big uh, factor, because in a lot of deals we see that year one pricing itself is pretty good. It's aligned with the market benchmarks, but the COLA clauses are so much in favor of the service provider that over the deal term, the TCP actually becomes quite out of line with the market norms. The next factor is substandard productivity glide path. So essentially, there is a lot of focus on transformation and digital levers to improve productivity. In a lot of cases, we see that providers are charging, a separate component for this transformation itself. But then, what is the net impact coming out of from those productivity improvement initiatives? Now, if that is again not in line with the market benchmarks, it can really escalate the fee for the end client. And lastly, substandard terms and conditions, that again is a pretty important factor to keep in mind. Across all of these, we see that the value leakage can be pretty stark. In second generation deals, the leakage could be as high as 42% of the overall TCV. For third generation outsourcing deals, the leakage could be, equivalent to about 32% of the TCV, based on our recent engagements. A lot of this actually is linked to what we discussed a few slides back. A very effective tool for enterprises to identify and plug the value leakage is to conduct comprehensive benchmarking of the contract, which goes beyond just the rate card benchmarking. So moving on, another important topic to cover is, what are some of the initiatives that we have seen clients take to improve the quality of services in deals? In that regard, today we are witnessing significant evolution in how service quality is being measured and managed. So while SLAs, which have been there for a very long time, in outsourcing deals, while the SLAs focus largely on operational metrics like response times, uptimes, etc., and these are pretty important clauses to have in contracts. But we are seeing the focus to now grow toward other aspects. For example, what is the actual user experience and having structured metrics around that. This helps ensure that service delivery aligns with the client's real business needs and user expectations, leading to more meaningful outcomes and stronger partnerships. Business and user experience align metrics like reduction in time to market, improvement in NPS score, deployment success rates. They are now becoming more common. And by adopting XLAs, which are experience level agreements, providers also have the opportunity to demonstrate a strong commitment to improving client experiences, building better relationships. In a way, standing out from the cutthroat competitive environment that is out there right now. Now, having spoken about the need for adoption of these XLAs, it becomes imperative to also talk about the need for clear communication with all stakeholders involved for better accountability, improved transparency, and overall better experience for all the stakeholders that are involved. Moving on to the next page. Abhishek, do you want to talk a bit about how we are seeing organizations actually implement XLAs?
Sure, absolutely. And XLAs, as we know, are not something new, right? Providers have often pitched XLAs as a differentiator. But the challenge then comes around operationalizing and assigning a tangible value to them. Right? So as we see, this was the case study where a large paper manufacturer, fourth generation outsourcing arrangement with an incumbent, pretty mature, right? They wanted to see more experience-led and business outcome-led metrics in their IT services contract. So what they did was that, instead of a big bang approach, over 5 years, as you can see the dial moving from pure SLAs to including, a few XLAs, and then eventually, having some part linked to business outcome metrics, right? So they didn't want to see a laundry list of XLAs. They wanted to actually have business outcomes associated, right? We mentioned that, the big bang approach is generally not well received, right? A phase-wise introduction wherein both set of stakeholders mutually align which one's working, which one's not working, which can be associated. It does take a little bit of a commitment, right, to get it right. So this was an example where instead of just having it on paper and good talking points, they actually operationalized it to quite a good extent. Moving forward, we also, as part of the webinar, we wanted to just mention that given current market dynamics, increased pressure, there is a challenge to find ways and means to derive maximum value out of each engagement. So the enterprise stakeholders, as part of this webinar, can sign up for a complimentary price check that would essentially show or allow you to gauge your current status against market norms and see if there is further value to be unlocked. I think if to sign up, if you could just click on the link, which is now available in the chat window. And once done, on that page, you can choose which are the functions and, the two roles for which you'd want the price benchmarks. And against these, right, you can choose two out of the list of 4 countries that you can see, right? Okay. So once we receive that, we'll be happy to prepare a short kind of, summary of the benchmarks and, engage in a conversation with you, right? Okay. All right. With that, handing over to you, Rahul, to lead us through the closing stages of the webinar. I think we can do some Q&A.
Yes, Abhishek, thanks. We have covered all the content for the webinar that we wanted to discuss, and we can take up some questions that have come up. So I'll start with the first one. The question is, what role is transformation playing in influencing deals? And are clients seeking transformation as an included value in pricing or happy to pay separately for it? So firstly, the the importance of transformation in today's deals cannot be overstated. Clients clearly want to move away from deals which are primarily FTE led, or deals which have got essentially some very basic tools or accelerators being uh, leveraged by the service provider. The intent that we are seeing is clearly to transform the existing environment, improve the existing processes, move towards a more efficient way in order to deliver the services. The reason for that is, again, pretty clear. Clients have a very clear objective of realizing savings from the way things are being operated currently, and using those savings to invest in various newer initiatives. For example, investing towards cybersecurity, investing towards a more robust data and analytics backbone for the organization, investing towards generative AI, so on and so forth. So transformation is clearly a very important factor in today's deals. When it comes to the commercials for it, there are actually a few deals, no doubt, where the cost of the transformation itself is not called out transparently. It is getting bundled into the overall deal fee. But buyers are actually expecting to get some transparency and to really understand, that for the transformation levers that are being proposed, what is the fee that the provider intends to charge. Next step in that assessment is also to get some details around what are the actual benefits that those transformation levers would yield, and hence understanding what is the ROI for transformation. So it's a very good question. Our advice is to kind of have as much transparency as possible in order to understand the costs as well as the benefits coming on account of transformation. Okay. The next question is, what is the impact of generative AI in the BPO space, and what are the pricing models for that? Arpit, you want to offer any insights on this?
Yeah, Rahul, I think generative AI has been on top of the mind for all the organizations, be it service providers or enterprises, specifically in BPO. And I want to counter this question by saying that all the automation levers, being the traditional automation levers or the generative AI automation levers, it depends on various factors like outsourcing maturity, uh, baseline automation already done in the environment, uh, the overall landscape of the processes, whether they are complex processes or the traditional transaction processes, and also the type of outsourcing. It's a second generation outsourcing or third generation outsourcing. So these are the many factors which influence the percentage terms of productivity which Gen AI can produce. As we have seen in the poll, what we have seen is that specifically 10 to 20% is the number which we have seen traditionally in the deals which we are currently observing to be the Gen AI productivity over on top of the traditional productivity improvement by the traditional levers. So yeah, these are what the current percentages which we are seeing, Rahul.
Thanks for that, Arpit. Next question is, in the context of evolving pricing landscape in APAC, how do you foresee the blurring boundaries and the shift in decision making and buying centers toward India, particularly through the use of global capability centers or GCCs? Abhishek, any thoughts on that?
Sure. Thanks, Rahul, and very pertinent question. I think there's a number of activities which are happening at the blurring between, let's say, boundaries across geographies, right? And GCCs tend to be at the nerve center of that, right? So a couple of things, happening. One is, when it comes to GCC related transformation, right? Many organizations have set up GCCs, and those who have not are in the process of setting up, right? So, or expanding. So there's a lot of work going on in existing GCCs, right, to expand or, transform, etc. So for that, decision and buying centers generally tend to be, there is a bit of a skew or a shift towards India, right? Just to make sure, because their GCC heads, they will coordinate with the others, and but still, the buying center is there. The second element is also around the fact that, in many of the GCCs, there are either product leads or process owners or significant senior people sitting within enterprise procurement, sourcing, vendor management. So in that case, also, when it comes to having a say in terms of, using or managing the vendors, from the GCC as a COE, or, onboarding vendors to support, the overall capability delivery, it definitely has a say. So you're right, it's not 100% there yet, but in certain companies, the lines seem to be blurring as to, where it sits. The one area where still the decision might be GCC related, but the lines are pretty clear that it will be in the source geographies, is something around the GCC setup. So we are seeing a lot of BOT assisted captive kind of deals. I think within that, it's more towards the home country, but the previous two which I spoke about were all about those blurring lines, as was there in the question. Yeah.
Thank you, Abhishek. Very pertinent insights. Okay, the next question is, when every pricing deal is unique, how do we use a standardized pricing model or a template? Um, so I think, generally speaking, we do not advise using standardized pricing models or templates when it comes to proposing services to clients. Uh, as the question itself says very rightly, every deal is unique, and hence the pricing template also has to be customized pretty much to the specific nuances of client's requirements. Um, so, having said that, what we have generally seen as a best practice is to think about the client's expectations or the client's requirements from the perspective of different types of commercial models that could apply. There could be some parts of the services in scope that are very, very conducive to a transaction based or an output based construct. These could be very repeatable work units which have a very high degree of standardization, for which the contours are very clear within the client's environment. So one could think of using an output based or a transaction based model for such kind of areas. Examples being server management, IT help desk, contacts, AMS tickets, etc. Second model, which should also be considered, is for some of those areas which are relatively difficult to really put your hands around. It's important to essentially use the traditional FT based or a TNM construct. And additionally, also needs to be kept in mind that buyers do want to see some kind of skin in the game. They want to really understand, is the provider willing to put a fee at risk, not from the perspective of SLAs only, but also with regard to achieving certain outcomes for the end client. So, those three are the pricing models to generally use for each and every deal. A lot of the deals that we seeing getting signed today, they are not just output-based deals. They are not just TNM deals or not purely outcome-based deals as well. They are actually a hybrid, where two or more of these different types of models are in place. So that's what generally we would advise, and not having a standardized template for pricing at all. I think we are actually pretty much towards the end of all the questions that we have received. If you just move on to the next slide, we also wanted to leave the audience with a message that, in addition to the webinars that we conduct, We keep on publishing, blogs covering some of the recent developments in the global services space. So it would be good, to kind of go through some of these blogs to get, a latest point of view on things that you also might be pondering over. With that, we are at the end of the webinar. A big thank you to my colleagues, Abhishek, Arpit, and Vaibhav for all the insights. And thank you to the audience as well for joining us today. All have a good day ahead.
Thank you.
Thank you.
Thanks, everyone.
Thank you, everyone.